Want to know what a defined benefit plan is and how to use loans in a strategic fashion? What follows is a fairly in-depth outline of defined benefit plans and their loans, largely in the voice of an IRS representative, but this will add value to you. That said, it's going to be, to a certain extent, groundbreaking when you look at the two combined. They are so powerful, entrepreneurs, it's crazy. Hi, my name is Kenner French, and I'm with you from Vast Solutions Group. You're a tax and financial engineering firm for entrepreneurs. We have over 50 years experience in helping business owners, probably just like you, in helping their situation. Now, defined benefits provide a fixed, pre-established benefit for employees at retirement. Employees often value the fixed benefit provided by the type of the plan. On the employer side, businesses generally can contribute and therefore deduct more each year than in a defined contribution or 401k plan, sometimes saving business owners hundreds of thousands of dollars at times. However, defined benefit plans, DB plans, are more complex and thus more costly to establish and maintain than other types of plans. If you establish a defined benefit plan, you can have other retirement plans of note, by the way. It can be a business of any size. You need to annually file a 5,500 number of other schedules, Schedule B, et cetera, have to have an enrolled actuary who determines the funding level. You can't retroactively decrease benefits. Now, what are the pros and cons of defined benefit plans? Substantial benefits can be provided and accrued within a short period of time, even with an early retirement. Employers can contribute and deduct more than other plans, as I said, provided that there's a predictable benefit down the road. Vesting can follow a variety of schedules from immediate to spread out over years. Now, these are pros, by the way. Benefits are not dependent on asset returns. The plan can be used to promote certain business strategies by offering subsidized early retirement benefits. The downside or cons: most costly type of plan, most administratively complex, plus an excise tax applies if the minimum contribution is not satisfied at times. Also, an excise tax applies if excess contributions are made to the plan at times. Now, who can contribute? Generally speaking, it's the employer who makes the contribution. Sometimes employee contributions are required or voluntary, but not generally. Contributions and benefit limits provided under the plan are very limited. Deduction limit is any amount up to the plan's underfunded current liability. That's what you need us for, a qualified plan. Filing requirements: annual filing of 5,500 is required, and enrolled, as I mentioned, actuary must sign the schedule and the various different schedules with the IRS. Now, yes, once again, there are loans. We're going to go over that, but generally a defined benefit plan may not make an in-service distribution to a participant before age 62. Now let's go over the loans. Loans, due to specific elements in the CARES Act, loans are greatly enhanced for participants. If you're interested in learning a little bit more about loans as it relates to defined benefit plans or qualified plans, please give us a call. Now, a qualified plan may, but it's not required to provide for loans. If a plan provides for loans, the plan may limit the amount that can be taken as a loan. The maximum amount that the loan can permit as a loan, specifically, greater than 50% of your vested account balance, or 50,000, whichever is less. There's a CARES Act twist here. For example, if a participant has an account balance of 40,000, the maximum amount that he or she can borrow from the account is 20,000. This is pre-CARES Act. Now, participant may have more than one outstanding loan at a time. However, any new loan added to the outstanding balance of all the participants' loans from the plan cannot be more than the plan maximum amount. In determining the plan maximum amount, in that case, $50,000, is reduced by the difference between the highest outstanding balance of all the participants' loans during the 12-month period ending on the day before the new loan and the outstanding balance of the participants' loans from the plan of the date of the new loan. Now, I'll give an example. Assume participant A has a vested account balance of, let's say, $100,000 and took a plan loan of $40,000 on January 1st of 2005 to be paid in 20 quarterly installments, $24.91. On January 1st, 2006, when the outstanding balance is $33,000, participant A wants to take another loan. the difference between the highest outstanding loan balance for the preceding year, $40,000, and the outstanding balance on the day of the loan, $33,000 roughly, is $6,600. Since the new loan plus the outstanding loan cannot be more than $43,000, $50,000 minus the $6,600, the maximum amount that the new loan can be is $10,000, which is $43,000 minus $33,000. A plan may require the spouse of a married participant to consent to a plan loan. Now, a plan that provides for loans must specify the procedures for applying for the loan and the repayment terms of the loan. Repayment of the loan must occur within 5 years, and payments must be made in substantially equal payments that include principal and interest and that are paid at least quarterly. Loan repayments are not planned contributions. A loan that is taken for the purpose of purchasing an employee's principal residence may be able to be paid back over a period of more than 5 years, depending. A plan also may suspend loan payments during a leave of absence of up to 1 year. However, upon return, the participant must make up the missed payments either by increasing the amount of monthly payment or by paying a lump sum at the end, so that the term of the loan does not exceed the original 5-year term. As long as a plan provides for loans, the purpose of the loan or the participant's ability to borrow the same amount elsewhere is irrelevant in determining whether the loan is permitted, unlike hardship or withdrawals, which require a demonstration of need. Now, loans are not taxable distribution unless they fail to satisfy the plan loan rules, right, in line with regulations, duration, repayment terms, etc. In addition, a loan that is not paid back according to the repayment terms is treated as a distribution from the plan and is taxable as such. You should talk to a CPA about that. Combining defined benefit plans and loans, especially during the coronavirus era, can help provide for retirement savings, tax mitigation, and potentially current cash flow, and maybe even potentially help you to hire an employee or two.